Today, I'm going to talk about the impact of quantitative easing in monetary policy on global exchange rate. First of all, before we learn this topic, we should know what is quantitative easing and how it be operated. The simple name of quantitative easing is QE, which is a monetary policy from central bank of creating new money by purchasing government debts and bonds. And these debts and bonds are basically medium and long-term debts and bonds. The interest rates will decline with the creation of more money by the central bank, so the consumers and business can borrow more and spend more to stimulate the economic growth. If we need to explain the relationship between QE and exchange rates, then we need to find a model, which is a exchange rate monetary model. The monetary approach to exchange rate can be related to QE, and it is also emphasizes the influence of monetary market equilibrium on domestic and foreign exchange rates. The model under this theory is the flexible price monetary model, which can explain this relationship. The real money demand functions KD and KF at home and abroad can be written as these functions. And among them, the K, alpha, and negative beta represents the proportion of income held in currency, the income elasticity of money demand, and the interest rate elasticity, respectively. From the perspective of monetary easing, purchasing power parity is always established and existed in commodity market, and that is these functions. In this way, the imbalance of monetary market can cause the adjustment of commodity market. And then we're using MSD and MSF to denote the domestic and foreign money supply and respectively. Then the domestic and foreign prices when the market is in equilibrium are these kind of functions, and then we substitute it into these functions. Finally, we get this kind of non-functions. And the Kf is numerator and the Kd is denominator. The above formula shows the foreign exchange rate is directly proportional to the domestic money supply and inversely proportional to the foreign money supply. When the domestic money supply respectively increases, foreign exchange rate appreciates and domestic currency depreciates. Foreign countries can spend less to buy domestic goods, which can stimulate the domestic exports, export profits, employment opportunities, and domestic consumption will also increase, while encourage people to spend more money to buy foreign goods, which lead to a devaluation of exchange rates as we talked above. And this reflects how the foreign exchange rates among all countries around the world are affected by money supply, especially in country-to-country trade by QE. The examples and data are also very important to show the relationships between QE and global exchange rates. Since the 2008 financial crisis, the United States has successfully introduced 3 rounds of quantitative easing policies, and each round of policy introductions has a certain impact on the exchange rate. QE1, the central parity of RMB exchange rate against the US dollar was reported at 6.8201, an increase of 19 basis points from the previous trading day. During QE2 and on June 22, 2011, the central parity of RMB exchange rate against the US dollar was reported at 6.4683. During QE3, on October 29, 2012, the central parity of the RMB exchange rate against the US dollar was reported at 6.2992. The result was a sharp depreciation of the US dollar and a sharp rise in the prices of global primary products, which could also shrink the US Treasury bonds in a short period of time, which play an important role in promoting the recovery of the US economy. And this data show the after 2008 financial crisis, the US states Fed launched three rounds of quantitative easing, and the US dollar continues to depreciate. And here's the sources for you professor to look for. And to summarize, the large amount of money supply caused by quantitative easing (QE) can depreciate the domestic currency, thereby increasing exports and alleviating some economic pressure. And two, increase credit supply and avoid deflation. And three, reduce borrowing costs for banks and companies. But it is more necessary to pay attention to and prevent the excessive money supply caused by improper implementation from QE and the recurrence of inflation. Thanks for your listening.